Hello, good morning, and welcome to another exciting moment where we talk about business. It is Business 360, and my name is Blyden Oken. In Business 360 today, we'll look at some of the biggest talking points, and one of it would be the U.S. trade gap that is above forecast, and we begin from there. The trade deficit in the U.S. widens to $61.5 billion in September, higher than an upwardly revised $58.7 billion, and its gap in August and market forecast of $59.9 billion. Imports were up 2.7%, led by cell phones, passenger cars, and crude oil. Exports rose at a slower 2.2%, and led by other petroleum products, soybeans, crude oil, and corn. Still in the U.S. The U.S. annualized debt interest payments crossed $1 trillion in October, according to reports. The cost of debt has doubled in the past 19 months as federal deficits balloon. And investing in China. He was at the Hong Kong Monetary Authority's Global Financial Leaders Investment Summit, and he had this to say. Let's find out.
And are you investing more in China? Are you worried about China's growth? How do you assess China right now as a place in which to invest?
Well, I think big picture, you could have been an investor in the United States at almost any point over the last 100 years, had solely a domestic investment portfolio, and have done extraordinarily well. The world's changed. There's much more innovation outside of the United States relative to 50 business leaders. The management teams in China are extraordinarily capable. They produce extremely competitive products on the global stage. They lead in many areas that are important to the world: solar, EVs. These are really important competitive advantages that exist in China. Companies, great management teams, great products. If you're a global investor, you've got to be watching and investing here in China.
Encouragement of investment in China. But still on the foreign scene, the Federal Reserve Governor Christopher Waller says the U.S. labor market is slowing down and normalizing during a speech in St. Louis. He also commented on the recent jump in the U.S. Treasury yield during a lecture about economic data. Let's find out more.
For the last couple of years, we have seen massive job creation after the pandemic and net hiring. I mean, we're seeing numbers that I had never seen in all my years working at the Fed. 600,000. There's one over 800,000. I mean, this is amazing job growth. But what have you seen lately? It's slowing down. The labor market's cooling a bit. It's getting closer to its kind of long run, or not long run, but kind of what we think the last 10 years did. So we're looking at the labor market. We're seeing it normalize. Kind of a phrase we use is the labor market's getting into better balance between supply and demand. So one of the things that matters is not just the short run rate that we kind of influence, the overnight or 2 year or 3 months, whatever short horizon you want to think about. But the 10-year Treasury rate is often the benchmark for many things, mortgages.
Interesting topic and a teaching from the governor of the Fed, speaking about a U.S. labor market and also looking at the intensity of the market. Now in Africa. Namibia is said to become the first African country to run a decarbonized iron plant. According to Namibia's investment promotion body, work on the continent's first decarbonized iron plant, which will run only on green hydrogen, began on Monday. Africa's inaugural decarbonized iron plant is using only green hydrogen, a cost-effective green iron production. The Ochevela project in western Namibia is set to produce 15,000 tons of carbon-free iron yearly. And some like good news there. Now in Uganda. Uganda replaces Kenya with Tanzania for its oil imports. Uganda and Vito Bahrain have chosen the Dar es Salaam port in the capital city of Tanzania as its entry point for its oil imports. Vito Bahrain had secured an oil supply contract from Uganda National Oil Business. Uganda seeks energy independence, approving a bill to end reliance on Kenyan distributors. That is a conversation around Africa, Uganda, and Kenya. But still on Kenya. According to Kenya's treasury, the nation is experiencing severe cash flow issues as a result of maturing loans that have caused delays in the payment of monies to several development projects. A Treasury Cabinet Secretary reveals financial challenges from short-term debts. Meanwhile, concerns loom over Kenya's ability to pay off a looming $2 billion Eurobond debts, and quite concerning in the country Kenya. Now in Ghana. Ghana is exploring a $400 million loan from cocoa traders to fund its industry operations. This development comes as the government is facing difficulties in securing an annual loan from international banks due to ongoing government debts and its restructuring. Meanwhile, COCOBOD has reportedly secured half of its targeted amount from the involved companies. In Uganda, Airtel Uganda's initial public offering, IPO, has generated limited excitement and attention on the local stock market thus far, despite high expectations. Airtel Uganda announced that its initial public offers, IPO, achieved a subscription rate of 54.45% from the 800 billion Ugandan shilling, an equivalent of $218 million, and the worth of shares offered for sale. The company initiated its share sale on August 29th, setting the share price at 100 Ugandan shilling to divest a 20% stake in the company. Now in Nigeria. Foreign airlines have disclosed that about 90% of their $783 million trap funds have not been paid. The airlines stated this during a stakeholders forum convened by the Minister of Aviation and Aerospace Development, Festus Keyamo, in Lagos recently. According to data from the International Air Transport Association, as of August 2023, Nigeria accounted for a substantial $783 million of airline blocked funds. Despite recent efforts to alleviate the situation, the airline said a significant portion of those funds remain inaccessible to them. Still concerning within the country. The federal government has so far saved about 1.45 trillion naira from earnings generated from the removal of subsidy on premium motor spirit, popularly called petrol, between June and September. This is according to the Federation Accounts Allocation that have received the sum of 696.93 billion naira in June, 389.7 billion naira in July, 71 billion naira in August, as well as 289 billion naira in September. President Bola Tinubu announced the removal of petrol subsidy during his inaugural address on May 29, 2023, saying, "Subsidy is gone." Meanwhile, before the removal, the Nigerian National Petroleum Company Limited, NNPCL, said it spent 1.828 trillion naira on subsidy payments between January 2023 to May 2023, 55% higher than the amount paid in the corresponding period of 2022. Still in Nigeria. The Nigerian National Petroleum Company Limited on Tuesday said it had launched a new crude oil grade Nembe and had shipped its first cargo in October, consisting of 950,000 barrels. Report has it that Executive Director of Crude and Condensate of NNPC Trading, Mariamu Idris, on the sidelines of the Argus European Crude Conference in London, said the first cargoes of a new grade were sold to France and the Netherlands. Nembe is similar to other distillate-rich grades such as Facados, Bonga, and Igena. It's benchmark, and it's a good grade to compete with Brazilian and Azeri crude grades for European refiners, she added. Production of Nembe is currently around 50,000 barrels per day, but the NNPCL said it is aiming for a rise to 80,000 barrels per day by the first quarter of next year and 150,000 barrels per day by the start of 2025, according to reports. We'll go on a short break. When we return, it would be Business 360 continuing, looking at global economy, and the analysis that comes with it, as well as the markets. Don't go anywhere.
The hostages have been underground in Gaza for 32 days. I cry out to every single person here and every single person on the planet to make it your mission to free these souls. To free these souls.
Welcome back. It is Business 360, and my name is Blyden Okem. Now to global economic analysis, looking at the markets also. While looking at the talking points amid events happening in Gaza and all the structural differences amid the war, it gets to affect the market differently. But let's talk about other markets and global economic data even further. Well, looking at analysis beginning with South Korea. South Korea records current account surplus for 5 months. South Korea posted a current account surplus of $5.42 billion in September 2023, staying positive for the 5th consecutive month, following the surplus of $4.98 billion the previous month, due to a widened trade surplus and increased dividend and its income from overseas. Racked up a $7.42 billion surplus in September, following a $5.21 billion surplus in August. The primary income account reported a surplus of $1.57 billion in September, following a $1.46 billion surplus a month earlier. On the other hand, the services account suffered an extended loss of $3.19 billion in September from a $1.57 billion deficit the previous month. Now to the commodity markets. Well, while Jim McCormick is standing by, the big question is, will the U.S. return to top corn exporter in 2024? The U.S. lost its portion as the world's #1 corn exporter to Brazil in 2023. But a combination of a similar Brazilian crop and excess domestic supply may see it regain the title to top corn exporter in 2024. Jim McCormick gives further details.
The United States lost its position as the world's #1 corn exporter to Brazil last year, but may regain it this year as a combination of a smaller Brazilian crop and excess supply of corn in the United States will potentially allow the U.S. to regain the world's top corn exporter title. Farmers in Brazil are expected to plant more soybeans and less corn in the 23-24 crop season, according to the National Supply Company CONAB, the country's food supply and statistics agency. Brazil total corn acreage is expected to decrease by 5% to 52 million acres, according to CONAB. The 23-24 corn croppers are projected to be down to 119.4 million metric tons, a 9.5% drop from last season, reflecting a smaller planted area and the initial effects of the El Niño weather pattern. After overtaking the United States this year as the